Hello from Arbitrum's open house in London. We are Bond.credit, and today we'd love to present to you our proposal for Agentic Risk Coverage, which is underwriting and coverage for capital markets managed by agents. First, some context. Agentic finance is going to be huge, and that's not just us saying it. Arbitrum is saying it, Robinhood is connecting AI agents to trading accounts as we speak. At the peak, agents were managing close to $250 million, but look at the chart. Since that peak, that capital has retreated by around 80%. The assets are moving on-chain, and the managers are changing too. So the real question is, what is holding that capital back? We're Bond.credit, and we're building credit for the agentic economy. And that involves a lot of different pieces, which we validated across different demos and hackathons, and this isn't our first rodeo. We won the Robinhood Innovation Track at Open House New York with our initial vault architecture. But here's what we found. Capital only moves as fast as trust does. In our conversations with liquidity providers, we saw a huge amount of fear, and that points towards another core part of what we're building, the insurance layer. Capital providers need to feel secure when depositing into agents, and coverage is a huge part of that. What we found is that existing insurance solutions don't fit. Our initial build focused on restaking capital to secure principal and yield, but the business around it wasn't sustainable. Then we looked into individual, tailored, bespoke insurance. Their coverage didn't sufficiently take the risk factors into account, and it was expensive to boot. So what's left for coverage is the slow, burdensome legal proceedings that are standard in liquidity provision, which means capital is constrained to the speed of human processes and decision making. And we think that's wrong. We think it should move at speed of code. So here's what we built. We made the risk a price. We spoke to Cork Protocol, who supply neutral risk market infrastructure, and brought in Zyfai, whose agents depositors have explicitly said they want cover. Together with these two key parties, we worked out how each stakeholder plugs in. And importantly, Bond.credit prices every decision off the specific underwriting data we've collected, data that bootstraps the whole system. Live on Arbitrum 1, on a live USDC risk market, Zyfai's agent requests cover on a position. Bond's agent prices the risk and quotes, and the agent can accept or counter. Here, Bond accepts, and the trade settles atomically on-chain. Cover tokens, in protocol's lingo, land in the agent's wallet, and the premium pays the underwriter. If the position ever decouples, the agent exercises into liquid collateral at a fixed rate. Hard limits auto-reject anything unacceptable, and in this way, a market for risk is created from the inputs of all the relevant stakeholders. All of this is valuable data that trains our underwriting agent to offer better terms, which attracts more liquidity, creating a data liquidity flywheel. We mentioned that Zyfai's depositors wanted insurance on their pools, and that's right. Their current pools are based on whitelists, which should be as safe as possible, and this is what enables that. The next exciting step is an open market where dispersed pools suddenly become available to autonomous agents for depositing. That way we cap the risk and unlock yield, expanding the total market available to participants. All in all, coverage builds confidence, and confidence moves capital. We're going into Q3 together with our partners Cork Protocol and Zyfai to test this build further. To do that, we need your help to seed initial pools and create a positive sum flywheel. Thank you to the entire Arbitrum and Off-Chain Labs team and everything that we've built here in London.